Okay. You need to give me participation. I think I'm looking for your. You need to grant me the to share permission to share. No, now I got it. Thank you. Okay. Can you see my screen?
Yes.
Okay, wonderful. Fantastic. That's exactly what I want. Thank you, Pandy, for reaching out to me and giving me wonderful introduction, giving to your community. I really appreciate it. I know Tamil Association for for a long time. Tamil Sangam, one of my friends used to be active member, Senthil. So Senthil requested me one time, I think 2016, 4 years back. This is my second opportunity. That's the reason, I accepted as you asked me. I'm more than happy to discuss the things with you. It's much more interactive. What I do is there's a lot of slides I created. What I do is some of them I may skip for the time, but you can ask gazillion questions right after the presentation. Uh, Please keep the notes and put it in your perspective, how it will, how I can apply. Hey, I'm a financial advisor. Hey, as an advisor, what kind of things you see, how you can address? Because I see a lot of people with multiple professions. I see a lot of IT people. I see a lot of business folks. I also see a lot of physicians and IT, all kind of people, and half of my crowd is close to mostly Indian community. Of course, American is most, yeah. So most of our crowd, I would say like 55% of my customers are Indians. So I know, being from India, I know what kind of things we have there, what we don't have here. So I can address things like inheritance. Somebody keep a tab on that. You ask me if in case if I don't talk about the inheritance in the sense like how it flows from parents to kids is different in US, and what are the things you need to take care of. So those things I will cover also. If any reason if I don't, please remind me. I'm more than happy to discuss, because those are the things you must address being in US. And Pandy said most of your crowd, most of the from Tamil Association, especially the active group. I mean, of course, there are a lot of friends came with me in the Tamil group. I know a lot of my good friends are in Tamilians, but they all came around my time, around like 30 years back. But somebody who came last 5 years, 10 years back, they may not know all the rules and regulations and what are the opportunities in America versus like being in US and India. So without taking too much time, I'll continue on that because of all the number of slides. But I don't want to overwhelm. But some of them straightforward. But I wanted to give you the real live picture. Hey, and first of all, thanks to Pandy and executive committee like Salvarajan, Salaganesh, Salvaraj, and Rajlakshmi, Manoharan, and Babu Natarajan. And thank you all for giving me opportunity to present the investment seminar or more of like a workshop. This is the caveat tempter. So this is a regulatory thing. Everything, whatever I say, hold it with a grain of salt. What I meant is double check everything what we say. I'm not a tax professional. I'm a financial advisor. So make sure, so you look both sides. So I wanted to cover that. So this is a disclosure. Investing in stocks involves risks, and neither Lakeland Management and its advisors provide tax, accounting, and legal advice. But if once you become our clients, I'm more than happy to work with you guys. And in case if there is a legal things like a drafting trusts and wills, I'll take it to a proficient somebody is confidential and confident professionals, so like lawyers, they draft it, and I'll work with my clients. So that's what we do. So the reason is why we do the financial planning, because 78% of the US workers, They live paycheck to paycheck. That's true story. It's not us, but a lot of people we're part of the society. A lot of people, that's what they do. 1 in 10 workers, with even people making 100,000, they live paycheck to paycheck. That's the reality. 1 in 4 workers do not set aside the money. So they're living tight. Nearly 3 out of 4 say they are in debt, and more than half think there always will be. More than half of the minimum wage workers, you can't imagine what COVID did to the average people, especially restaurant and travel industry, leisure industry. They got impacted tremendously. So that's the reason, bird in the hand is two in the bush. Saving money now when you can, that makes a huge difference going forward. So always, be liquid. Being in US, be liquid. Being in India, you have assets like properties, or you have some support base, family support. And in US, you are on your own. Even you see in COVID time and back in India, something happened, nobody is showing up. So unless you are on your own, it's a reality check. Nobody is there behind you. You are on your own. As long as you're financially stable, you feel comfortable. So the retirement planning is like, how much determine what you wanted to achieve, educate yourself, and so that you can take informed decisions, determine like, how financially, what kind of things you need to concern about. People don't think about job losses. Sometimes it do happen, especially you're on H visas and all that, in the legal issues, that kind of thing. And health problems, people don't expect, something unexpected things happen. That's the part of the life. Deaths and social security benefits. I mean, you're far away for social security, most of you, but you got to look into that. And based on that, you can plan the financial products, what you need to know, how you allocate your assets. What's my retirement funds, what's my personal retirements and the company sponsored retirements, and beyond that, how I am investing. So in India, you may buy some piece of land, or buying a buildings, those kind of things we do. But here, most of the people's assets are in the financial market. So understanding the financial markets and get to know them gives you a big picture. So I try to address some of the things you could do, and so that way we can go take the informed decisions. And major threats are, for especially investing community, when you are an average person, is longevity, how long you're going to live. In 20s and 30s, we don't really worry about it, but those are the things you need to worry, concerned about it. The biggest threat is inflation. You cannot avoid inflation, taxes, and debt. Those things never go away. So you have to address inflation. And I'll tell you why the inflation is so much. Especially countries like India, inflations are like in double digits, and 10% to 9%. Even with the 2-3% in US and developed countries, that's still a threat. And then you need to concern about estate taxes and withdrawal penalties if you are into retirement. And the biggest thing is the taxes. You don't want to avoid taxes, you want to minimize taxes. You need to mitigate the taxes. You need to look into, the taxes are one of the important components in financial planning, right? So everybody, people are retiring early and living longer. So those are the two things you need to remember. If people are retiring earlier than they plan to, but they are living longer than they used to. So those are the things, two different couple of things you need to be concerned. Yeah. So this, I wanted to help estimate the cost of, how much it costs and how the purchasing power is going to impact. And, I'll try to explain those things. Thing is, when we are young, what we think is, oh, I'm going to work until 65. I retire after 65. But in reality, this is numbers came from EBRI, Employee Benefit Research Institute. These are the true information. And what they did was, people think, we'll work all the way to 65, but the reality is 67%, 2/3 of the people retiring before 65, before reaching full retirement age. There could be a number of reasons. It could be health, could be an accident, could be something, whatever things happen. people retire earlier than the things. You know, people think before 60. Only 9% of the people think they're going to retire at 9. But third of the people, 35% of people retire before 60. Not even full retirement is 65 or 67, but 60, before 60. Everybody, it's a lot of people retire. Could be n number of reasons. That's why bird in the hand is two in the bush. Start saving, start investing. So here, the inflation, what we talked about. So first of all, longevity. Longevity in the sense, if you are 50 years old, you can expect safely you live until 81. Let's say if you're 65 years old, you're going to live until 85, at least 20 more years. You know, so the life expectancy is improving and growing up. So people are living longer. So if you are 65 years old, so 70% of 93% of chance you're going to live until 70, right? And 68% of the chances are you're going to live up to 80. So 90 years, almost third of the people live until 90 years. So you have to plan. Let's say if you are 40 years old, so you're going to live 40 plus 45 years more. So you have to have money to last 45 years old. And then, you know, of course, you have kids' education and your retirement and then inheritance, all those things. So those are the things will come in order, right? Probability of living 65 years or old, if you are 65 years, just retired, your chances of 9 out of 10, one of you or your spouse are going to live up to 80 years old. And almost 70% chance you're one of you are going to live up to 90 years old. So you're just because your investments, you don't stop. Okay, I invest until 65. No. You stop working at 65, but you still have to invest beyond 65. At least 30 years, your money has to last. The second biggest thing is, one is the longevity. You live longer than what you estimated. And second is the inflation. Inflation is erosion of the wealth. Let's say you put money under the blanket, $100, and 10 years down the line, you take the $100 out. That $100 is not $100. In fact, it is maybe $80. Reason being, the inflation. I'll explain why. The inflation is that the prices change in the prices. The inflation is the change in the price, right? Change in the cost of the, cost. So overall inflation in, like, let's say 99 to 2018, the inflation went 50% up. Let's say you have $100, and close to 2000 in 20 years, it dropped to $50. Your value is $100 become $50. But your earning, the wages are increasing only a little bit more than inflation, 68%. But your health insurance, they're growing really crazy, 240% change in 20 years. That's a lot. That's you need to address what is the healthcare cost now. 10 years down the line, it's not the same. And I'll put it in another perspective. Let's say you have $5,000 in your pocket. Let's say, okay, conservatively 3% inflation. And the prices are growing only 3%. Today, $100 worth of, like, something you want to buy, some gadget in the shop. Tomorrow, $103, and the next day is $106. You don't see 1 year or 2 years the big difference. But if you look into the 20 years down the line, $5,000 is the current $5,000 in 20 years. The same 5,000. You need $9,000 to purchase exactly what $5,000 buys now. Same thing in 30 years. It what $12,000. So you need $12,000 to compensate the $5,000. Okay, in reverse order, if we go, let's say $5,000 today is only worth 3,710 years back down the line. And 20 years down the line, it's only 2,800. Same thing 30 years back, you can see in the chart. So it declines the value. And let's say this is the true number. So recently I got it from Labor Department. 1994, median home in United States is $106,000. Now the median home is $380,000. And imagine like a 24 years down the line, same house you're buying in Collierville, maybe worth like a $900,000. The house will go up. You know, the median house is going to be projected at 835,000. So a gallon of milk, like 25 years back, is $2. That's the average cost in United States. Now it's $3.19. And in 25 years down the line, it's going to cost $7. Same thing, gasoline, you know, now $2 in Tennessee, where in other states, $2.60, then average. It's going to be $6 down the line. So inflation erodes. So the reason I am saying is, just because you put the money under the blanket and keeping away, it doesn't address the future expenses. And this is the big thing. If you have a college kid, you know much better. If you are sending your kid to public school, the cost is public school is around $86,000. It's going to be $140,000, like 16 years down the line. So if you have a 2-year baby, imagine that you should plan to pay $140,000 per year for the school. So those are the numbers you got to look for. And same thing if you are sending to private college, what happens? Right now is $194,000, and it's going to be $340,000 20 years, 15 years, 16 years down the line. So keep that in mind. And let's hear, I'll give you a simple case scenario. So it also impacts most of our lifestyle. Here, like Bob and Cindy, like a wife and husband, you know, they're planning to retire in 15 years. Let's say they are 50 years old. And, you know, right now, let's say you're spending $1,000. When you retire, you don't need $1,000. You need only $800. The reason being, your house is paid, your cars are paid, assuming your, you know, all kids are gone, so you don't have that much expenses, right? So you expect 80% of that. Let's say they conservatively they're leaving $5,500 per month for utilities and all the expenses, food and all that. It's only $5,500. So let's say only 80% of that they needed when they retired, right? That means $4,400. But here, look at this magic number. Let's say the inflation, if the inflation is going 2%, only 2%, 10 years down the line, you need to multiply the numbers with 1.2. You know how it came? 1.02 power 10. You know, you're math people, you know, you're all engineers, you know how it works. So if it is 5, it's 1.02 power 5, 1.1. You need to multiply with that number, right? So you understand that. So if you go back, here, like, you know, let's say assuming 3% inflation, 15 years down the line. So they're going to retire in 15 years, right? You need to multiply that number with 1.55. You got it, right? So now, if you multiply with that, so the 4,400, 15 years down the line is equivalent to 6,855. That means per year, $82,260. And let's say, so they are 65. They are going to live, let's say conservatively 20 years. They may live more longer, but just leave it only 20 years. So 3% inflation means 1 year, you got to multiply with 1.03, 1.03 times 1.03, and keep adding all those. For the next 20 years, at the end of the 20 years, the annual expense is going to be $148,562. So you add up all these 20 years of the bare minimum for $4,400 to live as current dollars per month, you need $2.27 million. So you got the numbers, right? At least I gave you a big picture how the inflation is going to impact your normal expenses, how much you need to save to live like a median life. Like, you know, you're not living luxury life, you know, $4,400. So the minimum assets you needed is $2.2 million. So if you are in 20s and 30s, it's a great time. Start investing, start saving. This is the, at least one nugget you get it from my seminar is this. Keep that numbers in your mind. So if you wanted to live in current dollars, let's say just bare minimum $50,000 per year. So that means if you wanted to live 30 years down the line, you need 1.2 million. You wanted to live like 100,000. So for 30 years, you live 30 years from now, you need to have at least $2 million. You see the number on the top right. So those are the reality. That's the reality. Those are the numbers. Okay, I think I scared enough. At least I gave you some idea. But this is what it is. Let's say you see this graph. Probably you never seen this. This is the total wealth. When you are young, you have more human capital. Human capital is present value of the future earnings. So your present value of the future earnings highest when you are at 18 years old or 20 years old. Once, let's say, assuming you started working at 65, your human capital is tremendous at the peak. However, your pocket is empty. Your financial capital is nothing. You just came out of college and you started working. Your financial capital, that means your savings are pretty negligible. As you get older and older, as you see in the curve, it's going up at 65. Your financial capital has to reach to the top, and human capital is declining. At 65, it's almost comes to the zero because you retired, you don't make money. So financial capital is zero when you are at retirement age. The human capital is almost zero, but human capital is highest as you are younger. So that's the reason your total wealth. A lot of people look, oh, how much money I have. That's not the thing. You need to look both. Add the financial capital and the human capital. That combined is your total wealth. So that's where you need to look for. So then now I'm going to talk about what are the retirement plans, what are the things you can save. And I also talk about your employer plans. On Social Security, I'm not going to touch that much. Because Social Security save 6.25 for Social Security and Medicare is 1.4. So 8.35% you save and your employer adds the exact same amount of money. That money is kept with the government. When you retire at 65 or 67 full retirement age, you get the money based on the last 10 years, the highest amount, whatever you made. Based on that, the government do the calculation, they pay you Social Security and the Medicare, which is nothing but health insurance. As simple as it is. So now I'm going to talk about the IRA accounts, Roth IRAs, and then other investment vehicles. And I'm going to talk about a defined benefit plans. That is nothing but retirement plan from the company, and defined contribution plan. That means that you contribute from your paycheck. Defined benefit plan is nothing but company saves for you. So I go on detail a little bit and then we'll jump on. So advantage with the regular IRA is, it's a tax advantaged. You can contribute whatever you contribute 100%, you can defer the tax. You don't pay taxes now, but you can take the money once you retire. But if you take the money out of that account before you turn 59 and a half, you got to pay a 10% penalty. Why government put the 10% penalties? So that you don't touch that money until you're retired. So they put the hypothetical age 59 and a half. Until then, don't touch. And then your money grows. Once it goes there, then you can start taking that money. So that's the traditional IRA. Individual retirement account, I guess. Yeah, that's what it is. You can contribute up to $6,000 per year. And if you are 50 and above, you can add $1,000 more. Let's say if you are working, your spouse is not working, like a stay-home mother, but still you can add $6,000 on her too, or he, if you are a woman, I don't want to be one side. So the other spouse can add $6,000. So married couple combined, they can add $12,000 per year into Roth IRA, in the traditional IRA, and you don't pay a dime of tax. But that money grows tax deferred. At the end, you pay the taxes, right? And there are some income limits. If you are married filing jointly, your income has to be less than 124. If it is 104, you can put up to full $6,000. Between 104 to 124, there's a sliding grade. Like, so you put less and less. After 124, you cannot do. The same thing with the single flyer, 65 to 75, the range. The next thing is Roth IRA. This is the best gift given by the government to average person. That this is what it is this works like a traditional IRA, but here in Roth IRA, you put your money after tax money. So traditional IRA, you put money before taxes and you get tax exemption for that. But traditional Roth IRA, you put after tax money, you put it into Roth IRA account. That money, the advantage with the Roth IRA is you can take the original money anytime after 5 years. Let's say you put like a $6,000, $30,000 in 5 years. That amount after 5 years, it went to like a 60,000. The original 30,000 you can take out without penalty. That's the one advantage. Second advantage is you don't regular IRAs, you have to take the money out after 72. With this Roth IRA, you don't have to take the money. It's a 70 and a half. I'm sorry, I didn't change. It's a 72 now. Actually, they changed it this year. So you don't have to take the money out from your account. And let's say after 59 and a half, all the money is yours. Let's say 30 years down the line, you kept like your money grew to like a couple of hundred, like 300,000-400,000. All the money you can take out and no taxes paid, because the money you put in for Roth 401k is after tax money. So that's the advantage. Put the money into Roth IRA. But just like a regular IRA, the advantage is tax deferral, tax-free withdrawals, tax planning, since you don't have to take the withdrawal by age 72. And to contribute both the regular IRA and Roth IRA, you have time for 2020 until 2021 April 15th. So the deadline is the tax time. So the time is tax line. So until April 15th, 2021, you can contribute $6,000 into either IRA or Roth IRA into up to April 15th, right? The next thing is these are the contribution limits. For Roth IRA, your income has to be less than 206,000, and below 206,000. I mean, anything 196, below 196, you can contribute up to 6,000. And between 196 and 206, there is a grade. There is a sliding grade. So you can, after 206, you cannot contribute. So that's the rules. The next thing is educational savings, right? I told you the educational costs, the inflation in the education and health is enormous. They're growing like 6% a year. That's no justification for that. But what you can do is you can contribute up to $2,000 per kid in Coverdale. That's like educational IRA. But you can put only $2,000. And then another plan is 529. With the 529, you can put up to $15,000 per kid. Like let's say wife and husband contributing, you can put up to $30,000 in the account. The good part is, let's say you have a lot of money sitting in your savings account. So you wanted to contribute. What you can do is you can put up to $75,000 at one shot for the 5 years. So for the next 5 years contribution, you can do it one time. So wife and husband together, you can put up to $150,000. When the kid was born, let's say you're flush of cash. Okay, I wanted to shower my kid with the education gift. You can put $50,000, $15,000 per person. So wife and husband, $30,000, 5 years, $150,000. You can do that, and theoretically. Roth IRA, as I said, anything you withdraw from the advantage with the Roth IRA is anything you withdraw for education for yourself or kids, it's free. But only its drawback is, why would you put your retirement money to your kids' education? They can borrow money if they need to, and so let them live by themselves. You don't want to. First thing is, it sounds selfish, but you need to look for your own retirement, then the kids. because kids are a lot younger than you. So they live longer than you. They make more money than later on. So they can survive. So first you look for yourself. And other investments, investments held outside your retirement plan. So like annuities, bonds, mutual funds, outside the, Robinhood, like you said before, Manohar, that's the thing, those kind of things. So the other things like a rental income, people do the rental business and all that. And Social Security, so the full retirement age based on your age, it is between 65 and 67. But most of you are here. Your full retirement age is 67 years old. But can I take the money before? Yeah, you can.
Yeah,
You're eligible to take the money at 62, but you lose money. And if you take approximately 30%, not approximately, if you take the money at 62, you lose 30% of your full benefits. So here is the thing: when you are Social Security, let's say if you are born at let's say 1960 after, I think most of the crowd, most of you are here born after 60, your full retirement age is 70. So if you don't take the money at 67, your money grows 8% per year. So the government, instead of giving $1,000, you wait until 70, every year they add 8% forever. But chances are you may not wait until 70. Most people start withdrawing money more. Then I'm going to talk about the next thing is qualified retirement plan. There are two categories. One is a defined benefit plan and defined contribution plan. Some of you, you're working for FedEx. You have defined benefit plan. That's a retirement plan. You have nothing to do with the plan. Government, what FedEx does every year, um, based on your last year's salary multiplied by the number of years you'll work there, and they have they put like 4% of it, something like that. They put your money aside. It's for the retirement plan. That is the so-called, in olden days people have retirement plans. That's what it is. Some companies now, they are not giving any retirement plans. Some companies like FedEx, they still have that. So the employer sets the money for you. The money grows, and when you retire, you have lump sum money, and then they give you annuity. So every month you get certain amount based on your number of years of service and the last paycheck you got. That's the defined benefit plan. Next is the defined contribution plan. What is defined contribution plan is nothing but 401k. Now, a lot of companies are not giving the retirement plan. So what they are going to do is they let you participate in 401k plan. With the 401k plan, you participate, you can put up to $19,500 per year. If you are 50 and above, you can add 6,500 more. That means you can contribute up to $26,000 per year. That money, just like how I mentioned in IRA, that money is a pre-tax money. And that money, you don't pay tax now, and you pay tax once you retire. And once you start taking the money, after 59 and a half, you can take the money. After 60, 72, you're forced to take the money. Before that, you don't have to take that money out. So that's the advantage with the contribution plan. The other advantage with the defined contribution plan or 401k plan is nothing but employer matches to your contribution. Let's say some companies put 2% when you put 2% money. Some people put 4% at 50% of yours. They match with 50% for dollar to dollar. That means you put 4%, the company put 2%. A lot of companies, they put up to, some of them, let's say they're adding 6% money up to, let's say 6%. So basically, if you don't put that money until when the employer is matching, you're losing money. You're giving away your money to your employer. Let's say you're making 100,000 and your employer said, okay, I will give you 5% when you put 5% of your money into 401k. So that means you put $5,000 into your 401k. your employer automatically matching $5,000. That means you're saving $10,000. But on the other side, think other way. Your $5,000 you saved in 401k, it's tax-free. Tax, you don't pay tax now. That's a tax deferred. That means, let's say you're on 25% tax bracket. That means $1,250 you save in taxes. So even though you are putting $5,000, you're truly putting $3,750. Plus your employer is giving $5,000. 5 plus 5, $10,000. And you barely get impacted with your paycheck will be less with the $3,500. So it's a simple math. So by all means, take advantage of the contribution plan. If your company is offering 401k and there is a matching plan, if you are not taking, basically you are going to lose the money. So you're giving away your own money, your hard-earned money. So hopefully that's the good point you pick up from this seminar. Advantages of defined benefit plan. I'm talking about the retirement plan. Employer is responsible. You don't need to worry about it. And no investment risk for the participants. And offers tax deferred retirement savings. So and it is guaranteed by the PBGC, like a pension benefit government corporation, whatever, the guarantee corporation. So that's pretty much your money is guaranteed if the employer has the retirement plan, defined benefit plan. Of course, I know FedEx has that one. So basically, just like works like an IRA. So tax deferred retirement. And so basically, I already explained what it is. Defined contribution. This is the 401k. He's talking about it. Disadvantages. There is not specific retirement, but the thing is that 401k investment risk is owned by you, not by the employer. So in the sense, you need to pick, when any employer, they put the 401k, they give you multiple options. One, they give you target date retirements, 2025, 2030, 2035. What it is, let's say you select a 2025 retirement plan. That means you have more, you are retiring sooner than the later. So that means that your money more will be in the bonds and less in the stocks. And if you are retiring 30 years from the line, let's say 2050 plan, that means they put more assets into stocks and less into bonds. The reason I'm saying is stocks, the returns from stocks are a lot higher than the bonds, but they fluctuate a lot. They move a lot. Bonds, they don't move a lot, but they give you very, very less. Nowadays, bonds, you get like 1%. That would be great. With the stocks, on average, you get like 7-8%, on average 8% return. But they fluctuate 10% or so, 10% up or 10% down. So don't get scared when things are fluctuating, but it's long run. So if you are younger, most of your money, you put it into longer, like a more aggressive funds. But when things drop, don't change, just stay put. Things go down and come back again. But if I'm like, let's say I'm 65-year-old, I put like 100% of my money into stock funds. What happens if something market drops 30%? I don't have cash in my hand, in my pocket. So that's the reason they have target date funds. And they have stock funds, aggressive stocks, moderate risk, balanced funds, all those kind of things. So you got to pick right funds. So because employer, if you lose money, employer has nothing to do anything. And they say, hey, we gave you options, you pick what you want. So if you have questions at the end, please talk to me and we'll discuss that. And a defined contribution, I said, like a 401k, 403b, and 457, all those kind of things. And the another one is a SEP IRA. The big thing you want to make sure for all your plans, make sure you add your beneficiary. By default, if you are married, the spouse is a default beneficiary. But when you have the plans, both the retirement funds and the 401k, make sure your spouse name is included in that. And 401k, I think I already mentioned how it works. And a catch-up thing. Here 2020, 19,500, you can add $6,500. And I already mentioned Roth IRA and all that. SEP IRA, if you have self-employed, if you are a self-employed, what it is you can put up to $57,000 for the 2020, or 25% of your compensation, whichever is the lowest, you can put the amount. So that's a great plan. If you're on your own, you're working for yourself, that's a great benefit you can take. And then with that, now we move into investments. So we talked about the different type of plans, what you can do, what you cannot do. And then we talk about the investments, what kind of the risks and returns. As I said, cash, this is kind of old slide. It's at like a close to 2%, 3%. You never get. Now banks are giving like a 0% return because short-term bonds are zero now. So aggressive bonds, they said 8%, but now I would say 4%. So these are the stocks as you go up here. The large cap stocks, you can get up to 12%, 11% return on the stocks, but the standard deviation is like a change from the mean. So 20% move you see stocks. Let's say you may get an average 11%, but you see the 20% move. It could go 32%, it could go negative 8%. So make sure when you have stocks, that's what it happens. You get good return, but you in short run, you have risk. As you said, like in the, if you look at the consumer staples, like if you can buy companies like Walmart, Target, those kind of things, people have to buy no matter what, right? Even COVID or non-COVID days or aggressive days or depression rates, it doesn't matter. You got to eat food, right? So these things usually they're lower risk, and the returns are kind of in the middle. But if you go all the way to the right, information technology, like Google, Apple, Amazon, those things are IT companies. The return has to be higher. The risk is also higher. At the same time, if you look at the utilities companies like MLGW, MLGW is not a public company, but if there are any utilities companies, they get you lesser return, but the lower, it doesn't move that often. So you got to have the balance of between these two. If you look at the CDs, if you put your money in CDs, basically you get nothing, nada. I mean, it used to be like 6-7% when the inflation high in 2000, and now CDs are, you don't get much. But hey, if you need liquidity, you need to have some kind of money into bonds and CDs. And historically, interest rates, 1980s used to be 20%. Now interest rates like a 10-year is less than 1%, 0.6%. The 10-year bond 1980 used to be 20%, close to 19%. Now it's pretty much close to zero. What happens is, we talked about stocks. The bonds, it goes like a seesaw. If the interest rates going down, bond prices go up. Interest rates going up, then bond prices go down. As the interest rates, bond prices go down. Now, what are the interest rates? They're all at 0%. What is the future? Going forward, the interest rates going to go up. What happens to the bonds? The bonds are going to go low. So you don't get a much return from next 10 years down the line. But here, this is the relationship. If you are like an interest rates are higher, as in this curve, as the interest rates drops, the asset price go up. And as interest rates increases, the prices of the bonds drop. So that's the relationship, is inverse relationship. That's what I was talking about. But if you look into the stocks, we talked about bonds. If you talk about the interest stocks, historically, in the short run, you have a lot of volatility. Let's say you hold your portfolio into stocks. At max, historically, if you look at the for past 25, 30 years, the max you get, you sometimes you got 26% average return, an average 26%. That's the highest. The lowest was 2.36, and the median was 13.96. But if you look into the 10 years, if you hold the stocks, and approximately 9 years, in the highest you got some areas, sometimes 19%, and the lowest you got like a negative 1%. But if you look at the 20 years, if you hold your stocks in 20 years, the highest you got the 20-year periods, there's 18%. The lowest was, the lower was 7%. On average, you got 12%. If you look at the historical long 28, 25 years, you can expect with the dividend close to 12.98%. So that's the historical thing. And it's hard to predict what happens, stocks, bonds, and what kind of stocks, aggressive stocks, like a small cap, large cap, and all that. So if you look into the historically, sometimes, real estate gets you more return. That means REITs. S&P gets like, some return, and commodities give you different returns. Small caps, every category, if you look into each year, they changed. Sometimes emerging markets give you more return. Sometimes small caps gives you more return. So rather than focusing on one and losing money, if you diversify your portfolio into multiple groups, like a fixed income, small cap, commodities, diversified, balanced funds, real estate, international stocks, emerging markets, you put all those together. So then your portfolio is much more balanced and it's going to get impacted a lot lesser, right? That's the plan. So, same thing I told you this, I put that same again, sometimes small caps get higher return, fixed income gets certain returns. Every year they fluctuates. That's the reason you need to have a diversified portfolio. So that's what it is. So diversification, what I meant is don't put all your eggs into one basket. Spread among into a variety of investments. And, each investment work differently, right? So don't limit to stock investments. Just don't focus, I want money in Tesla. I want to put my money into Apple. Don't put all money into just stocks. Diversify, put some money into bonds. The reason being, you always need to have a dry powder. Remember, always need a dry powder. In the sense, dry powder means dry gunpowder. If your gunpowder is wet, you can't shoot, right? So you want keep some cash ready, irrespective market is a boom market or bust market. When things go really, really bad, you don't want to sell your portfolio, your hard-earned golden eggs. Let them hatch there. And when you have cash, like a $100 stock drop to $20, you need cash. That's why you need to use that money when things are ugly. So in long run, stocks go up, all the asset prices go up, but the things fluctuate. When the things fluctuate, you need to minimize or dampen the volatility, right? So diversification is yearly. And here is the simple example. When you are 25 years old, you started investing $1,000 for 10 years and you stop at 35. And the other guy started 35 and every year is investing $1,000. See what happens. At 65, assuming nominal 8% return, X ends up with $147,000. Y end up in only $114,000. All he did, X did was 25 years old. He started 1,000, 1,000 and 10 years and he stopped and he waited until 65. When he came to 85, he's way ahead of the Y. He started at 35 and he's been investing every year $1,000. So starting early, especially you are a lot young crowd here, I want you to start early. The sooner you start, the better off you are. So here is the same, this is graphical representation. This guy, he put the money 25 to 35 in the bottom line, and he left it there. And the second guy started at 35, adding all the way. He ended up at 114. The first guy from 25 to 35, he stopped it there. You look at this, his money grew to hit 147. Nowhere ever the second guy Y was able to reach near close to X. You see the graph. This is a true graphical representation. That's the power of compounding. Let's say an employee making $60,000 and came with the conservative number. I mean, most people make 100 or plus. But you save only 4% of your money, assuming your salary is growing only 2% a year and market is growing at 8% a year. All you are saving is 4%. only $2,400. Your money end up into close to half $450. You save only 4%. You add just 2% more, your money goes up like to 550,000. Let's say if you are saving 6% of money, which is not bad, only 3,600 out of 60, your money reaches $670,000. So that is the power of compounding. So start early. By all means, start early. Any questions, people like me, more than happy to answer. So at the same time, let's say, this is my other thing. The other one, sorry, there was no growth in salary. You just stick to the guns. But if your salary is growing 2%, of course, obviously, right? Because of the inflation, you get that. This is the more realistic picture. If you save 4%, you get $500,000. 5%, you get 700. At 6%, you get $850,000, $30,000. That's, ladies and gentlemen, that's the power of saving early and investing early. And by all means, never stop investing. Okay, once you retire, let's say you have retirement, let's say you have million, this 500,000 is a hypothetical number. It doesn't matter. It could be $1 million, $2 million, $3 million, $5 million. It doesn't matter. If you take your money 4% a year, your money lasts 16 years. If you, and your money lasts 43 years. If you take 5% a year, your money lasts 30%. If you take 6% a year, you take 22 years. So let's say you want 100,000 per year. So all you take is only 4%, right? But your money is growing 8%, but you take only 4% of the money. Your money lasts 43 years old, 43 years. Let's say you are 65 tomorrow and you have a couple of $1 million, $2.5 million. You take 4%, how much? $100,000. So that you take $100,000. I mean, of course, it's inflation adjusted. It lasts 43 years old. So 65, I don't think you live 43 years old. Let's say you live 30 years or 25 years. Rest of the money, you don't have to give it. It goes away. You have inheritance, right? Your kids, somebody else, or charity, whatever. So that's the reason, bird in the hand, in the sense what it is you push harder till retirement at 65. Once you're there, all you need to do is 4%. Or if you want to take more, yeah, take 5% or 6%. If you take 5% out of $2 million, that's $2.5 million is like $125,000, like a 100, yeah, 30,000 plus. That's a good number. Okay, these are the milestones. If you are 50 and 50 and 50 above, you are reached 50. I don't think that many in this crowd here. You can add $1,000 more to Roth IRAs. Instead of 6,000, you can put 7,000. And 401k, you can add $6,500 additional money. And if you turn 55, you have 401k with another company and you move to the other company, then you can take the whole money without penalty and move it into your IRA, whatever. Or you can pay taxes and keep the money in your pocket. If you are 59 and a half, you are eligible to withdraw money from IRAs and 401k without penalty. Why would you take money unless you need to take it, right? Once you reach 65, Medicare kicks in. You don't need to pay health insurance. Until then, unfortunately, in America, you have to pay health insurance on your own. Before Obama, guess what? If something happens to you, there is no other insurance plan. There is no coverage for pre-existing healthcare. So it's not India. This is America. This is a big difference there. Traditional investments, I skipped this one. We already talked about longevity, mortality. There's repeating this, and I already covered this, and I already covered this. Yeah, so this is the thing. It's easier to going up the mountain than down. So take advantage of the tax benefits when you are young. Diversify your assets. Automate the savings. Your 401k, make sure you participate that. Your retirement plans, you participate in it. If you're investing every month, set aside. You're saving, set aside. So it's a bird in the hand. Then and you general sense of retirement. Once you have that, and uncertainty is on the other side. You don't know how longevity and when to withdraw. When you have the money, we can look into. These are the things you do after the retirement. Okay, this is the most important. Okay, I think I'm getting echo. This is the most important thing you wanted to look into. If you have estate plan, the reason I said that in India, I wanted to ask the questions after that. In India, you have properties. Your father had like a couple of $1 million worth of assets, whatever. And after your parents passed away, your money automatically comes to you. If you have siblings, they go to both of you and your siblings. In US, it doesn't work that way. You have to have a will. Without a will, money doesn't flow to heirs. Okay, that's the first thing. And second thing, you need to have a trust. People think trust means, oh, I need to have my $1 million. No, will means even you have will, the people, the courts, they go through probate process. That means it takes like 4 or 5% cut because they want to make sure you don't owe money to anybody, any credit cards, any heirs or unknown kids you may have. They wanted to see whoever other people can get. So without a will, there will be probate process. I mean, even with the will probate process, if you have trust, that there won't be any probate process at all. So make sure your bank accounts have beneficiary and your investments accounts have TOD, transfer and debt. Make sure you have some spouse or kids names there, and make sure you write a will. Make sure you have a trust. Trust is not expensive. If you like, let's say, have Hyatt plan in your FedEx, it costs you pretty much nothing. But if you don't have will, make sure you need to write the will. Those are the things, durable power of attorney, a living will, and if you have properties in other state, they go through the probate process. Make sure they're all under LLC. Those are the things an advisors can answer or a lawyer can answer. So make sure those kind of things. So there is one example. Somebody asked me, like, how do I look into my mortgage? Let's say, yeah, well, some of the things you want to make sure, am I spending more? Bird in the hand is two in the bush. Saving a penny is like more than having $1 in the bank. So if you have let's say now interest rates are low. Let's say you're paying 6% for 30-year loan, and you paid 4 years and 26 years left. So that you are paying like $1,800 per month, right? And there is, let's say after 4 years, let's say you have $283,000 left. The remaining payments you pay 312. So with the 6% higher interest rate, you may be paying $561,000. So if you refinance, let's say if you take the principal out, there are $277,000. That's the principal, and you pay the interest $277,000 for the entire rest of the 26 years, right? Let's say interest rates drop. What you could do, let's say 3% costs $3,000 for closing costs. So you need to look into, I have the principal 283,000. Let's say my closing costs are 3,000. It costs, total is 286,000. Now let's say you are getting 4%. Then 20-year loan is 4%. So with that, you calculate, you pay, your principal amount, you pay $17,000 in the next 20 years. And you save interest on $130,000 if you refinance from 6 years interest to 4%. So with the 2%, your interest change, you save $130,000. It's a lot of money. So you got to plan accordingly how the interest rates are. It's not, we're talking about investing, but you are also looking into stop the bleeding. You want to make sure when you are doing the whole financial planning, you need to look into how I'm paying for my home, those kind of things. Okay, before I do that, there is a small trivia. If you know, I want you to watch this one. Count number of baskets. What is that? Count how many times the players wearing white pass the basketball. Okay, this is a simple game. Let's do this.
This is a test of selective attention. Count how many times the players wearing white pass the basketball. How many passes did you count?
Yeah, count how many passes.
Correct answer, 15 passes. But did you see the gorilla? This video is from research by Daniel Simon.
Yeah, most of the people, when I said that, a lot of people don't, they don't realize how many times, the gorilla, they count they focus on passing, how many passes are there. We focused on so many things. In the life, this is in the real life situation. In the life, this is what happens. We stick with the family, we stick with certain things, but we don't look for saving for in the future. That's the biggest gorilla, is your retirement. So that's the reason you manage by yourself, and certain things you take help from your advisor, financial advisor, your tax accountant, and attorney. These three are pretty important allies in your life. If you reach your advisor, people like me, we can work with you and help you, and working with your tax advisor, and the working with the attorney to write the wills and trusts and taking care of that things. Thank you for giving the opportunity. This is Srini. Here is my email address. I live in Lakeland, so lakelandwealth.com, Srini@lakelandwealth.com. Anytime you can reach out to me. I'm more than happy to work. I did work before, and I helped some people from Tamil Sangam also. I'm more than happy to take questions from here, Pandy.
Right. Thank you, Srini. Thank you so much. A lot of information. So
I
it's
know,
really
drinking with the firehouse.
yeah. So we are from IT background and still we are managing, right? So a lot of new information, and especially we appreciate you with the statistical data because we don't get it outside, right? We talk about verbally, okay, how things, what about the investment stocks? We verbally talking, but we don't know the actual statistics. So appreciate you. Thank you so much.
Thank
Yeah.
you.
So members, please, yeah, you can start asking the questions.
Hey, probably I can go with the
Hi,
question.
Sanjay.
Hey,
Yeah.
Srini, well, I think I have a couple of questions. Maybe I start with the one, I leave it to the others. I went to your website while you're in that one. I just want to see what you do, how you help things. Can you touch what kind of help you can provide? Like most of the things, what you covered is good, but I just want to see how you can help if I'm going to come to you.
Sure. The financial advisor, what we can do is like a lot of people, as I said, like IRAs and Roth IRAs. Those are $6,000 per year. You can put that money, and that money, and educational IRA, those kind of money, you can pick and choose where to invest, because that has nothing to do with the funds. The funds usually they charge 1% on typical mutual fund. Your 401k, when you invest, your money also, its cost of investing is 1%. That you don't see that. You see your portfolio fund return 16%, but actually it returns 17% because the 1% is paid to the advisor. So that, I mean, the whoever is managing that fund, when you have like multiple funds, there is some drag, which is okay. So when you come to an advisor like me, if you have let's say you work with company A, and then let's say you work for AutoZone, now you move to FedEx, and you have 401k there. Let's say you have 50 grand there. They have two options. One, you leave the 401k there, or you can open a rollover IRA and you move that money. So if you leave that money with the ex-employer, they charge you additional fee, because that administration fee they are paying when you are employee. So you can avoid that by moving your money into rollover IRA, and that money we can manage with multiple stocks and bonds. That's the one thing. And a lot of my clients, they invest every month certain amount. So what I do is as long as the client starts with approximately 50 grand, and then I'll work with them to invest the money. The reason I said 50 grand is that way we can diversify the portfolio into multiple assets rather than, let's say Google is $3,000, Amazon $3,000. You know, unless you have ample money, you cannot diversify. Otherwise, until you reach that amount, we got to put money into ETFs. So we can take full advantage of the investing that. But those kind of things I do. And I also take care of the personal planning, financial planning. All my clients, we do complimentary financial planning. Hey, how much I make now, how much assets I have, based on that to reach my retirement, how much I need to accumulate. So we plug in the numbers, and of course I know being CFA charter holder how to calculate the numbers, and I also have software which basically does exactly the same thing, but we calculate how much you need to have the money, and we look into whole global picture. I look into how much your 401k has, how much IRA retirements have. Based on this, how much you need to save. As I said, like, you know, it's now people acting Tina. There's no alternate. So everybody's investing in stocks, but there are risks associated with this. There is no free money. Everybody thinks that money comes out of the pocket, but it doesn't work that way. It's not, money doesn't come from trees. We need to balance it out based on the future forecast. What kind of funds we need to put your money in, what kind of risk we can allocate based on this. So each individual case is different. Some people make a lot more money, some people make okay money, some people save money, and some people have obligations to put money somewhere, send it to India. So those kind of parents, those a lot of obligations are there. So we look into all those, and based on that, and we invest. That's what I do.
Thank you.
Thank you.
How much you charge per hour? Like, you know, if they come to you, like, you know,
consultation is free. I don't charge. A lot of people charge a couple of thousand. I don't charge. I never charge. And all my clients, I do free financial planning. You know, put it into software. That I do complimentary. I don't charge, and I'm more reasonable. No, I charge assets under management 1% on the asset charge per year. So relatively, a lot of people, I mean, most advisors, the markets usually go 2%, but I never go beyond 1%. That's the max I charge. Yes.
Thank you.
Mm-hmm.
Good question. Thank you, Sundar. Any other questions?
Retirement economy.
In the 401k, right, there are so many multiple options they are giving, right? It depends upon the age I need to take the risk, or even in the FedEx, I saw it with Vanguard. I think they send a flyer also if they want to maintain my account or something like that. Sure. Is it advisable to give to them to manage my, or do I need to manage myself?
Wonderful. So say your name again. Can you state your name?
What's it?
Selva Ganesh.
Selva Ganesh. Yeah. I mean, if you have a 401k plan, you can do on your own and you can manage. And if there are like questions on about, you know, if you have an advisor, people like us, we can guide you through. So that way you don't have to pay the fee. But if you pick the Vanguard and all those people, they charge 0.5% for managing the assets. Basically, they do the same thing based on your risk profile, based on your age, how you wanted to do that. But if you wanted to do by yourself, by all means, if you don't know where to allocate your money, but just pick the target date fund. Let's say if you wanted to retire 20 years down the line. So you add 20 to the current year. So 2040, you pick the 2040 fund. So what happens is based on your asset, your age, as I mentioned before, okay, based on his 20 years of retirement age, let's put like a 70% of the money into stocks. As you come close to the retirement age, what they do is they slowly cut the stock portion and increase the bond portion. Same thing with the kids. You know, you put 529 plan. If your kid is 5-year-old, you start like if you start at a 2-year-old, 1-year-old kid, by the time their end period for the 529 is 18 years old. So by the time you're 18, you need to have cash, right? So they make sure you have ample cash by the time you reach 18. So before 1-year-old, 2-year-old, they put 90% into stocks, only 10% into bonds. There is no point putting 90% in bonds for the 1-year kid or 2-year kid or 5-year kid. So as the kids get older and older, every year they shuffle slowly. Same thing in your case. If you are retiring at 65, you are 45, you're retiring in 20 years, you take the age-based fund, and they slowly every year they shuffle it. So you don't need to worry about it. Just hang on to that and they slowly drift it. What we call is in 401k, there are two types of things. I'm glad you asked me. People do two mistakes. One is 1nth rule, and second is the status quo bias. Two type of biases. We all have biases, right? And we are humans, so nothing. The most people, they see the statistics, Vanguard, Fidelity, and all those people, big shots, BlackRock and all those people. What they found out is to diversify. What they do is like if my company FedEx offering 10 different funds, aggressive fund, middle fund, like income fund, growth fund, value fund, and bond fund. What they're doing is 1/10 rule. They take the $10,000 of 1/10 here, 1/10 here, 1/10 here. If you have 20 funds, they put like 5, 5, 5, 5. So that is a naive diversification. You don't want to put just because the funds is there, everyone is there, so you drop a dime there. So you're not going in a temple and every god you put the $10. It's not that way. It doesn't work that way. You have to have ideal diversification and strategic diversification. That's where advisors add value. And of course, if you are comfortable or going reaching out, then by all means pick the fund, and that way you can avoid the fee. But if you have, things you pay for lawyer, accountant, and advisors, it pays you off much more than what you spend. But of course, my self-interest is there. But you hold it the grain of salt. Anything I already told you. But yeah, that's the way it works. So the diversification and picking the funds and that kind of thing.
So in general, what is your advice for a person if they are earning like $10,000 per month? How much percentage they need to save it for retirement?
If I were you, I put it every dime. Reason being, that's me personally. But having said that, if you are one person working, this is the rule of thumb. That's the heuristics. Rule of thumb is you must have six months of savings in emergency fund. Reason being, you never know what happens. You may not get job like 1 month, 2 months, 3 months, 6 months. So as long as you have money for 6 months, you're fine. If you're married and your both spouses are working, ideally the recommended is 3 months, in at least 3 months. So you can make a call between 3 months to 6 months. And that money, you put it in the money market fund or CDs. They don't give any return, but it gives you peace of mind. So peace of mind is more important. Anything after that, what would you do is just invest into, if you're like a 40 years old and you're retiring at 65, what do you do having $100,000 money in cash? And what will you get from bonds? You don't get much. That's where you put it into stocks and stock funds and mutual funds or investing accounts. That's where people like me, I do mostly with, I create a separately managed account and create multiple stocks and create that itself a mutual fund for each and every client. Some people buy, if they are not educated, some advisors, they don't have financial background, people like me, like a CFA, charter holder, so they do CFP. What they do is, nothing wrong, they're all good. What they do is they try to help you put money into different kind of funds and ETFs. So it depends on the skill set of the advisor, but they all help you to reach your goals. The ultimate goal is you want to have liquidity by the time you retire. At least, to have an ordinary life, like $100,000 is not much. So you need to have at least $2.5 million by 65. So that way, money, bird in the hand is two in the bush. So the more you have, that's the big thing. And the second thing, it's a lifestyle. That's the most important thing. If you are, this is a human nature. If somebody has like a Porsche car, I wanted to buy like a Beamer, or binge or something like that. So our habits makes the huge difference. You never compare yourself to your neighbors. You always compare yourself what my target is, where I am right now, how I'm going to reach. But if you compare with the neighbors and if you compare with the other people, you never have peace in your life. I mean, one and two, there is always it's like a road race. You don't want to do that. Just because some guy is going 90 miles per hour, you don't want to catch that guy. So let him have fun. You want to go 60 miles per hour. So same rule here. First thing is lifestyle. How below means I'm living. That's the thing. But most Indians are very conservative, what I know. So we don't show off. We live below our means, and our lifestyles are more modest. As long as you have modest lifestyle and don't show off, you pretty much, most of us reach the goal easily. So ideally 20 to 25%, I would say. 50% of my, the best advice I got, I'm an advisor, I got an advice. I was working in Minneapolis, right? I was in 20s. My wife joined me later. And then I was moving to Chicago. The lady, one of our managers there, and she said, Srini, what are you doing? And I'm going to Chicago. And she said, are you comfortable living by yourself with the salary you have? I said, of course, more than happy to. I'm happy. And is your wife is going to work in Chicago? I said, yes. And she said, the one advice I can give you, live with the same salary how you are living. And the one salary is completely save that money. That means she recommended me to save 50%. I never upgraded my lifestyle. I kept it like that and I saved money. So if I can give you one advice to you, I mean, you're all prudent people. I mean, you're all highly educated people and you know what you are doing. But the thing is, a penny saved is a penny earned. The money you save and invest, typically in an average market returns are 8 to 9%. You can expect. But on the other hand, when you are investing in stock market, you see enormous fluctuations. And 2003 market went 35%. 2008 market dropped 35%. And 2018 November December time, market dropped close to 25%. And 2020, within 1 month time, market dropped like a stone, sinking stone. But if you are afraid and allocate money into different assets, that's where the trouble is. You don't want to shuffle the money. You need to have consistency and persistence. And that's where the advisor helps you. Hey, if it is my money, I may get scared. If it is somebody else's money, advisor is there outside and they say, he or she says, just stay put, and these are the right investments you have. It may go down for a while, but it will come back again. So the long run, you don't lose money if you have right kind of investments. But most mutual funds, stock funds, and all that, they if you hang on to that, you don't lose much money. You have the proper diversification, and you also need to take a little bit risk. Without risk, you don't get much money.
Srini, one more question. In case if I'm having the mortgage, right, every month I need to pay certain amount of amount.
Is it Selva? Can you state your name?
Yeah, Silva.
Okay.
So is it advisable to close my mortgage first, then do the investment, or do I need to run both investment as well as?
Mano is shaking his head. No. Yeah. The thing is here, what's your interest rate, Selva?
3.125.
There you go. Nowhere you can get that kind of interest rates, right? So by paying extra, you're saving 3%. Okay, let's say you paid off your loan and you're saving 3%. So if you invest in the equity markets, and in general, anywhere 9 to 10% returns on the long run. So you have excess money, rather invest at the higher return, and your borrowing cost is 3%, and return is 9%, 10%. So the gap is 6%, right? That's where you make money. So if you have 3% interest on the mortgage, I don't even pay a single dime extra money to my bank. my mortgage. And where in the world you get 3% cost of capital? That's a great return. I mean, great money to have. It's good to have a debt. Okay, there are a couple of things. We're afraid, culturally, we're afraid of debt, right? So that the debt is bad. Yeah, it is bad if you have a credit card. Yes. You bought a car on loan, it's bad. Yeah, if you have car loan, you're paying 6%, you pay it off. That makes sense, right, Salva? But if you're home, you're paying like a 3% or 2%, some people. What's the point paying that kind of money for 2%? Rather, you invest somewhere. A balanced fund gets you 6%. Aggressive growth fund gives you 12%. When you get that kind of return, why would you pay anything more than need to? I don't pay even a single dime. It's good to have a debt. Even you are 65, you have that debt with the 2%, 3%. And rather, I would love to have that kind of thing. And some other cases, like let's say if inflation is 2%, 3%, and you are locked with 3% interest, bank is taking the hit. You are not. Like tomorrow, interest rates go up to 6%, 7%. Bank wants you to pay. You don't want to pay. I said, no, I'm not going to pay. So interest rates are low now, but you got great rate, you're locked it, and tomorrow inflation reaches to 3%, 4%, 3%, 2%, whatever. And interest rates start going up. It won't stay low like this. And once you start reaching the 6% by 6% is normal for so many years. If the 6% is the cost of capital, but you're locked at 3%, you're happy. Why would you pay? And when you're buying new home, anyway, you got to pay the current rate. But I wouldn't pay a dime more. It's a good debt to have. Mortgage debt is good debt. So just to hang on to that, I don't mess with that.
Yeah,
and
thanks.
you use that extra money, excess money, the way you want it to invest. The way your returns are higher than the cost of capital. Cost of capital is 3%. Yeah, you're fine.
And Srini, one more clarification. You mentioned that instead of investing on stock, you are advising to invest on funds. Is that right?
It depends on the fund. No, that's a good point. Let's say with less money you have, let's say 50 grand or less, it's hard to invest in individual stocks. So rather you can have ETF funds. ETFs, you have like S&P 500 is 500 shares of S&P index. You buy that S&P, you get pretty good decent return. S&P returns are close to 9-10%. You have the decent return. If you invest money into, let's say tomorrow Tesla stock, what happens if it drops down to $3,000, $2,000 you put, and it drops down to $1,000? Your risk is higher, right? Having like a few stocks. And investing in stocks is not, anybody can buy, right? Click a button, you can get it. That's not the way investing works. You need to know the underlying dynamics of the company. You need to understand the financial statements. You need to understand the balance sheet, the cash flow, how much income it is generating, how much growth it has, and what's the free cash flow, what's the debt it has, and those kind of things. All those things you need to know before investing in individual stocks, not just randomly buying somewhere because some TV guy told me to buy. You shouldn't do that. But however, if you don't have time to do all that, you don't have acumen, skills, by all means, nothing wrong, but you still have good funds, ETF funds, and pick the good winners and hang on to that. And keep investing in that. That's not a bad option at all. Yeah. By all means, if you have less money, it's hard. It's not a good idea to put money into anything below 50. I would rather put into ETFs and ETF fund, mutual funds, and that kind of thing. Yeah, it may cost you 1%, but it's okay. It's okay because rather than losing shirt, you get 9%, 8% return. That's much better than bank returns, right? Bond returns, right? Yeah. And by all means, first of all, put the 401k. Make sure you have the 401k match up to the match level, and make sure you put Roth IRA. If your income level is below the scale I gave you, that's the second thing. And make sure you have extra money to invest. Invest on your own or invest with an advisor, people like me or whoever it is, and that's the third best. That's the third step you want to do if you pass first two steps. And then Yeah, I mean, then make sure you have the wills and trusts are written. And trust is not an expensive thing. It's not for rich people. It's needed for every person. That's the big difference between US and India. Make sure you have will and trust. Basically that's what it is. And beyond that, things, when you are investing, things will move back and forth, up and down. So you need to look for, have a good strategy. Somebody, help you set the goals and make sure you need to have your own checks and balances. Hey, where I am right now, how much my debt, how much my assets. If my debt is credit cards and car payments, I'll tackle that first, because you don't have advantage. I know your car loan is 6%. You bought nice Porsche car, but you borrowed the money. You are driving like a high-end car. All I see your car, I don't see your debt. You're showing off to me. I'll be happy if you paid off all your Porsche cars and BMWs or Benz cars. By all means, you drive it. But you address these first, and then you go from there. And you have a $60,000 car, you have $50,000 debt. What does it make? What do you get out of it? Nothing, right? Yeah, it's a show off. No, the first thing is, I said, inner scale you need to have. Do not judge by looks, right? Don't judge the book by the cover. So don't get worry about who is who and what and yeah. First thing you look for your own, and then you keep investing. Don't compare with others, and that's the major thing. That's the human tendency. They say in English there is a saying, right? Don't compare with neighboring Joes. Don't compete with Joes or something like that. Don't compete with Joneses. Yeah, they have. You don't know what they are going through. You know what you are going through. The good debt is, I said, mortgage debt. Car debt is bad. Credit cards are bad. You paid off every month. That's good. They give, just because they gave you 0% interest teaser rate. No. I don't need. If I don't need money, I don't take it. And that's a self-discipline. Once you go through that, all that, I think by this age you shouldn't have any debt other than mortgage. Mortgage is, I said, good debt. Okay, I think I answered the question.
Yeah, thank you. Any other questions? Okay. Yeah, so still, if you have any questions, please write an email to srini@lakelandwealth.com. I hope he will answer. So it's a conclusion part. Thank you, Srini. On behalf of MSTS, we truly appreciate your effort. Thank you so much. Thanks for effort. Thanks for time.
Yeah, and it's been recorded, right? You are going
yes.
to share
yes, I'm going to share it. Yes.
Yeah, with the other members. Yeah, that would be great.
Yeah.
Thank you so much for inviting me.
Thank you.
Yeah, please reach out in case if you need to. You have my information. Pandi has my information. Thank
Sure.
you. Mm-hmm.
Thank
Bye.
you. Thank you.
Thanks, Ed.